revenge of Europe. The Eurozone debt crisis is yet again creating market turmoil. So what are companies doing to compensate? Joining me is Bob Moritz, the chairman of accounting firm PWC US. Bob, you're located in almost 160 countries. What are you advising your clients on regarding the European debt crisis?
Just like anywhere else around the world, we're actually advising them to focus on three things. One is to make sure they understand their customers locally. The idea here is bring a great customer experience and a great quality product. The second thing is to focus on cost management because, again, the euro crisis right now has a lot of uncertainty. You're not sure which way it wants to go. You want to be prepared for the best. And last but not least is think about the scenarios that might play out. And by focusing on those three things and keeping a long-term perspective rather than a short-term perspective, we see companies still being able to operate efficiently within Europe.
Okay, and what are you telling your clients about what to do if there is a breakup of the Eurozone and if Greece exits? Because that's a huge concern.
Yeah, I think with that, with Greece potentially exiting, and it is still a long shot and a potential, we're basically telling people to stay focused on the long term. The reality is that will cause basically market volatility, but not necessarily changes in the consumer behaviors. So as a result, that's why we continue to have people focused on consumers, cost management, and again, making sure you think about the various scenarios that play out.
And what clients will be hit the hardest by this crisis?
Well, I think when you look at Europe, every core organization, not only in Europe but around the world, is going to be impacted by this because it has a contagion effect. The reality is it changes the mindsets, and that consumer could be sitting in Europe or even in the States, or for that matter, even in China. The world as we look at it today is tremendously connected. And as a result, any little hiccup, as we see in the markets any given day, something happens with Greece or Europe or across the board, it has a bigger impact.
Now, what sectors specifically?
Well, when we look around the world, let's go to what's working and what's not working so well. So when we actually survey CEOs around the world, right now places like healthcare, organizations and service organizations, when you think about technology companies, all of them are doing very well. When you look on the other side of the equation, the banking industry clearly, potentially the real estate industry, and what I'll call the financials clearly have a continued downside to that because of the risk and the volatility that ultimately will be put on them.
What are you advising your US-based consumers about Europe or the slowdown just globally?
Yeah, when you look globally, you clearly see a slowdown. When you look at Europe, you look at the combination of what's happening particularly in China. But the reality is companies that actually have kept a long-term focus are doing extremely well. They're hiring, they're innovating, they're actually deploying talent around the world to where they see the upside potential in lots of different markets. A good example is China. Even though we're seeing it slow down, there's still upside there, tremendous upside. But what you have in terms of really best-in-class organizations, they're focused on the next tier of countries that they want to be investing in. And that goes to the Malaysias, the Indonesias, the Africas of the world, again, with that long-term focus.
Let's move over to China specifically. I know you just had mentioned that. But growth in China is slowing. We're at 7.6 GDP. This has to be making your clients nervous.
I think it's making them nervous in the totality of the whole. It is what's happening in Europe. It is the slowdown in China. I think it's making them nervous because of what I'll call the contagion effect. So if China slows down, what implications does that have on the U.S.? If China slows down, what implications does that have in Southeast Asia or in Africa?
Well, what implications does it have?
Well, I think you've got then reduced investment. I think you've got then, again, negative consumer demand because of the mindset being shifted. And as a result, then the buying patterns shift. And as a result, then it's really incumbent on the organizations to up their game in terms of how can they grab market share because no one's buying. So now it becomes a market share game, not necessarily a pricing game. And that's where everybody's trying to focus on how do you do more for less and really bring a great customer experience to retain them over the long term.
And you must have worst case scenario plans in place.
Well, when we look at these, you always have to have worst case scenarios play out. And I think the doomsday scenario is what I'll call a more global contagion effect. The U.S. at least is trending along in that okay category. China still growing, albeit less than so. But I think the doomsday is if you see Europe go bust relevant to the Eurozone, you continue to see China bring itself down, and then the implications on the States put you into double-dip recession or worse, then clearly everybody's focused on changing the strategy overall.
Okay. Well, let's move over to the U.S., and we've got U.S. GDP at 1.9%. New numbers are coming out Friday. It's supposed to slow even further. Are these acceptable numbers, in your opinion?
Not acceptable at all, clearly. But everyone again is trying to make the best that they possibly can at the difficult situation that everyone's in right now. The reality is, when we talk to our U.S.-based clients, they actually feel pretty good. And I mean what I mean by that is there's upside. It's creeping along. It's sloped in the right direction, as opposed to some of the negatives that are coming out of Europe. So as a result, they're trying to focus on differentiation. And this comes back to local innovation. It goes back to diversification of your product offering. And I'll tell you, the biggest challenge that U.S. CEOs are dealing with right now is actually finding the right talent to develop their strategies and implement them. A CEO survey we did recently, almost a quarter of the CEOs said the biggest challenge I face is not actually having the right talent in place.
And why is that? Why is that?
Two reasons. One is because you do have new skill sets that are needed in these organizations. When you think about technology, when you think about social media, when you think about marketing going digital, those are new skill sets that there's not a lot of people in the States. When you think about engineering, another good example. But that probably ties more to having the skill sets from an education system sitting here in the States as opposed to them maybe sitting elsewhere. We're not as competitive anymore. So skills mismatch as well as then ultimately pulling them in at the right point in time is really critical for a CEO.
And in your opinion, what sectors are driving growth right now here in the U.S.?
U.S., it's all about healthcare. We see a little bit of an uptick in auto, but again, they're starting off at a relatively low base. But as a result, the supply chain has a bit of an uptick to that as well. When you look at, I'll call it the services organizations, a lot of corporates have said, you know what, do I need to be in this business? Can I outsource? Can I get more productivity? So the spill-off effect is these service organizations that are doing a really good job picking it up and picking up that market share. So they actually take the risk on their balance sheets as opposed to the corporates having to take it on theirs.
Mm-hmm. And last week we also spoke about healthcare driving growth, technology. Where in those two sectors are you seeing the most growth?
Oh, I think in healthcare you're seeing it across the world, but with a particular focus on U.S. and then in Asia. In the U.S., we're actually trying to rethink the healthcare system. In Asia, we're actually trying to define it from start. When you look at technology, I would say 6-9 months ago, that was actually trending in a significantly growth opportunity. Today, it's slowed down a little bit because, again, a lot of people made significant investment over the last couple of years in actually getting productivity and leveraging technology. So today, it's actually now slowing down a little bit. And the reality is those tech companies are trying to innovate to say, how can I grab more market share?
Okay, Bob, thank you for coming in today.
Happy to be here.
That was PWC U.S. Chairman Bob Moritz. I'm Elizabeth Carrazza. This is Reuters.